and welcome to Crystal Ball. A crystal ball gazing is absolutely needed at this point as we step into the new year because there seem to be several moving parts. Suddenly, in a matter of 6 months, the nature of the commodity markets have changed so dramatically. When have we last seen halving of crude prices all in just a matter of 4-5 months? As well, definitely in 2015 at some point, the Fed is likely to raise rates. Europe is in recession. Exit threats are coming back yet again. China, clearly the slowdown numbers are getting slower and slower. And in India, enough moving parts. The government has managed to push in some ordinances, but still public investment and even private investment is simply nowhere in the horizon. India Inc. is a deeply despondent lot, and yet the markets are up 31%. So crystal ball gazing is what we want, and the guest whom I have today is someone who has done a lot of crystal ball gazing and quite clearly adept at it. Akash Prakash, Fund Manager and Chief Executive Officer at Amansa Capital. Akash, good morning and thank you very much for joining us. A very happy new year to you.
Thank you. Thank you.
Okay, let me start with the global scene since with your perch in Singapore and your experience of having seen global events, you'll be better placed. Do you think fund flows will not be an issue? The markets will be sufficiently hydrated in 2015?
Yeah, I think globally, yes, I definitely agree with that. I think that most of the central banks, Europe will have some type of quantitative easing at some stage. I think it's inevitable. Japan obviously has signaled with Abe coming back that they're going to continue doing that. And I think my own view is the US will be very slow and gradual to raise interest rates and take liquidity out of the system. So globally, I think liquidity will not be an issue for financial markets. Markets will not correct because of liquidity reasons, in my view. And central banks also are very conscious that they don't want markets to come down. So that's not a problem. EM, I think, has another problem, emerging markets. So while liquidity will be, I think, strong for financial markets globally, I think EM obviously has had another bad year last year as well. I think it's now 5 or 6 years in a row where EM has significantly underperformed developed markets pretty much since 2009 actually, and EM doesn't look good at all. So you have easy liquidity. Normally that would help risk assets like emerging markets, but I think there are a lot of people who have a lot of concerns around emerging markets, and I think that will continue. Yeah,
exactly. When the mother market, US, gives you an economic growth of 5%, which is the last number, will the temptation to invest more over there, where there is no currency risk, be just that much more? So, incremental fund flows to India, do you think we can be as confident as 2014?
I think we got what, 15-16 billion?
Yes, 16 billion.
I think something maybe slightly lower than that or around that is realistic. I think I've written this also, that the reality is most emerging market investors are now overweight India. The regional guys and the gem guys for sure. All surveys indicate that. So it's unlikely in an environment where global EM managers may not get big chunks of new money. It's unlikely to get a very significant new source of capital from those investors. Where we will get flows of capital are from global investors or specialists, people who are not exposed to India yet. So I think India will not get dramatic flows from foreigners, in the sense it's not going to be a 25 billion or a $30 billion a year like what you saw in I think the year before, 2013. 12 to 15 billion possible. I think that's realistic. These are obviously numbers and no one knows, but I think the direction is that, in my mind, the leadership for the Indian market from a flow perspective is going to move from foreigners to domestic investors.
Okay.
And I think that if people are thinking you're going to have another 25-30 billion from international investors, I think that's unrealistic, because most international investors who have an emerging markets mandate are already overweight India, and that's very clear. All the surveys indicate that.
Okay. All right. That's not sounding too positive. But a lot of the bullishness about foreign flows stems from the fact that crude has halved in the last 6 months, and that's an India advantage. Let me split it into two. The first question is, what do you see the trajectory in crude and commodity prices, and how should an equity investor approach that? Should he rejoice?
Yeah, I think two things. One is that I think crude, from an Indian perspective, lower crude obviously better than higher crude, right? So there's no question on that. I think the point is, but the speed and the pace of decline and the quantum is so significant that there are going to be some dead bodies somewhere in the system, right? Because I wrote an article. There's like $400-500 billion of inventory losses lying somewhere in the petroleum value chain. Now, obviously, someone is sitting on these losses. So there could be unintended consequences of that, in the sense that, someone has taken a big hit on crude and therefore is forced to sell equities or bonds or something like that. So there will be pain in the financial markets because of such a steep decline in crude prices. But for India, it's obviously a positive. I mean, no question that we'd obviously prefer lower crude than higher crude. But I think for the overall financial system, there are significant losses lurking somewhere in the system where we are hopefully can be papered over. But we have to be careful of that.
Okay, now because of this crude advantage, and that's, we import, I believe, our bill is $100 billion. And if crude price was at $100 per barrel, if it is $60, then it's clear $40 billion less. But how does it translate into the markets? For one thing, the government is not passing it all down. It's keeping a lot of it in the form of higher excises. So CPI may not dramatically come down. Typically, how will you approach India?
I think to answer your question, I think two things. One is that it improves the macro picture for India dramatically, right? In the sense that there is no one now would talk about the current account deficit in India, right? Because it's come down to 1.4, 1.5. Number one. Number two is that it may not dramatically help inflation, but it does take some pressure off, because not just crude, but the whole crude link, right? Fertilizer prices come down, and there's a very large number of commodities. Freight costs will come down. International transport costs will come down. There's a whole bunch of prices
derivatives
indirectly to crude. Number two, and number three, it does give the government some fiscal space. And I think, like you said, that I think the fact that they're not passing it on to consumers means consumption may not go up dramatically in India, but obviously that the income and revenue they're generating from this, they can use for public investment. So it improves India's macro in multiple ways. On the current account, for sure. On inflation in a more subdued fashion, but definitely. And it gives the government fiscal space. So it is obviously a big positive for India. But my question on flows actually is not that I'm negative on flows to India. I just feel that that India now, among emerging market investors, is very clearly understood to be a good story. And most surveys indicate that India is a consensus overweight for emerging market investors. So they are unlikely to be able to increase their weight. So the only way that the emerging market investors will put more money into India is if they get more money. They can't increase the allocations within the pool they have. But if you take a view that EM is having an issue and may not get huge chunks of new flows into EM as an asset class, then from this set of investors, getting large chunks of India is not possible. But what will happen is there are new investors who are global mandates, not emerging market mandates. You're seeing signs of a lot of them getting interested in India, because in a world where there is very limited growth and most countries are fighting deflation or fighting recession, India is one of the few large economies where growth is accelerating, in the sense where we did 5.5% GDP this year. We'll probably do 6.5%, something like that in the coming 12 months. Inflation is coming down, and we clearly have the scope to cut rates. So India looks very interesting. So the hope is that we transition from money coming from GEM to money coming from global investors. But the real story, and I still say this, is the real upside in India will come when the domestic investor base turns, which the signs are already visible that they're starting to happen.
Yes, it is. Actually, I want to ask you a whole lot of questions on India and how you view the political economic setup. But just one more global question. China. The latest the latest number we got from a PBOC advisor is that for the current year it would fall to 7.1% from 7.3%. A lot of global watchers believe it will be much lower. So basically, China.
China stats all over the place. I wouldn't put a hard number on that, but I think it's very clear that China is entering a period of much slower growth. Now, that growth is 6, 7, 5, and frankly, that's a debate, and the numbers are all over the place because of the quality of China.
Does that mean that, therefore, 2015, we can be very sure that across the board commodity prices will have a bear year?
I'm not sure you will have a bear year, but they clearly don't have much upside. I mean, I don't know how much more downside they have. That frankly, I don't know. And commodities are also quite volatile, and they depend on the incremental demand-supply situation, so it can move up and down a lot. But I think what you can say with some level of hopefully not certainty but confidence is that there's limited upside to commodity prices now. I mean, they may go up down 5-10%, but I don't. Another year down 25-30%. I think that's unlikely, because then you'll go below the marginal cost curve for almost everybody, and then production will start shutting down. So I think what I could say is that you want an environment where you have commodity prices pretty much bouncing around where they are today. Hopefully that will happen. Not for crude. Crude may have a different dynamic, but for most other commodity prices.
Okay. No, that's important for us to get a view of how much we can expect inflation to move down in India, and therefore in terms of rate cut expectations. Those questions to Akash Prakash after a short break. We are back in a jiffy.